Hello everyone. Today is the lecture number 10 for engineering economy. And so in the previous class, we have started the chapter 4. We said chapter 4, we're going to talk about the interest. And also we will use the cost estimating technique we have learned in chapter 3 to calculate all the costs, and then we want to um, um, illustrate these costs and expenses for the lifespan of the project. And so today we're going to continue that the concept of interest, and then we're going to learn how do you describe your cash inflows and outflows on a cash flow diagram. And after that, we will learn how to compare different options. Okay. All right. So before that, we want to announce this homework number 2, which is due on September 20th, 11:59 p.m. It's already available online. So you just go ahead and finish and submit. So the rules are all the same as the homework number 1. You can submit many times, as many as you want before the due time, and the system will catch the highest score you get. Okay. And you won't be seeing the correct answers until after the due time, which makes sense, right? Okay. And just a reminder that we also have a attendance check number 1 available on Canvas, and it's due the same time as the homework number 2. So I just want to remind you that if you haven't done that attendance check questions, please go finish that. They're just very simple questions, true and false, and it's all based on the simple concepts we have learned in the previous classes. So the intention is to check if you have been watching the videos. Nothing else. Okay, it's not a test of if you have learned the technique or if you can calculate or not. So that's a very easy to get points. So just don't miss it. Okay, so just recall like what we have learned in the last class about interest. We said interest is something like an incentive to convince somebody or a bank or a company to invest in different business projects, right? So that's an intense incentive. And to calculate the interest, we said there are 2 types of interest. One is simple interest, which means every time you calculate the interest, you just need to use the initial amount you borrowed times the interest rate. Okay, and so every time you use the same initial amount times the same interest rate. But there is another type of interest called compound interest. And this one is more popular and more common actually in the daily life. So this type of interest means that every time you calculate the interest, you not only consider the initial amount you borrowed at the beginning, but also you need to include all the previous interest in the past interest periods. So every time you calculate interest, your base of the interest calculation is bigger and bigger. Okay, which means every time your interest amount is gonna be different. And also to calculate that, we have tried the manual ways, and we manually filled out that table. You remember that? It's complicated, But here we also have learned the equation method. So on this slide, you can see this equation, right? If you are using compound interest method, your interest, I, is the principal, the initial amount you borrowed or you lend, times 1 plus I is the interest rate per period, okay? And to the power of n is the number of periods, number of interest periods actually, okay? And to be specific, the n is the how many times you calculate the interest during that, several years, okay? And then you have to minus p so that you can get the interest itself. And we said the total payback should be the total interest plus the principal or the initial amount you borrowed, right? So this is what we have learned in the last class. But here I want to point out there is a thing very tricky here. That's the n. Okay, so usually we will say you borrow some money from the bank for how many years, and after that many years you need to repay it. Okay, that's a very normal story. So usually, you think that many of years, 10 years, 5 years will be the number of interest period, right? Well, it's not necessary, because you really need to you need to clarify with the bank that how often or how do they calculate the interest. Do they calculate the interest every year? If yes, then yeah, so the 5 years or 10 years, that time period will be your number of periods. That will be the value of n. But if the bank said, okay, you can borrow the money for 5 years, but we calculate the interest every month. Okay, so you borrow for 5 years, but interest is calculated every month. Well, that's a different story. That means your n is not 5 anymore, because n is the number of interest periods, right? It's how many times the interest is calculated. Actually, this is the real definition of n. So in this case, you borrow the money for 5 years, but interest is calculated every month. So you count how many times the interest is calculated during the 5 years. That's very obvious. So you got 5 years, and every year you got 12 months. So actually your n is gonna be 60 instead of 5. Does it make sense to you? Because every year the interest is calculated 12 times, right? Because it's calculated every month, and each year have 12 months, which means each year it calculated 12 times. And for 5 years in total, it's calculated 12 times 5, which is 60. Okay? If you don't follow this, pause and then go back to watch this slide again. Why in this case n is not 5 but 60? Okay, I can also write the easy case, like if you borrow for 5 years and interest is calculated every year. Okay, if it's calculated every year, then your n is 5. No problem. Okay, try to compare these two cases and see if you understand why I said n is a little bit tricky. Now here is an example. Okay, I will show you like how the n changes. Okay, so here still you borrow 1,000 from the bank at an annual interest rate of 10% for 5 years. Okay, it's exactly the same as the example we showed in the last class. But here you see interest is compounded every half year. So now what is the total payback? And also we need to remove this annual interest so that the statement will be not, confusing. Okay, so the interest, so every time you use the interest rate 10%, okay, and the interest is compounded, which means it's calculated every half year. Okay, so how many times it's calculated during the 5 years? What's your n? That's gonna be 5 years times 2, because if you calculate it every half year, so every year you calculate it twice. For 5 years, you calculate it 10 times in total. That's why we now have 10 rows to fill up. Okay? And the first row will be the half year of the first year. The second row will be the end of year 1. And the third row is half year of year 2. The fourth row is the end of year 2, and so on. Okay, until you get to the end of half year, the end of the 5 year, the year 5, sorry, the end of year 5. Okay, that's why you have 10 interest periods instead of 5. Okay, now the other thing stays the same. At the beginning, you borrow this much, and then because this is a compound interest, so every time you need to calculate your interest, okay? So your I for the first period will be 1,000 times 10%, which is 100, okay? And then the money you owe the bank in the end of the first period will be the initial amount you owe plus the interest, right? And then we said we copied this to the second period, to the beginning of the second period. And and during the second period, you need to calculate your interest again, and that will be a new base. Remember that, because this is a compound interest. So the new base of that will be the initial amount, or no, the amount the initial amount you borrow plus the interest in the previous periods. And here you only have this as your previous interest, so it's gonna be this, that's your new base, times 10%. Okay, and then the new amount you owe at the end of the second period will be the will be the amount you owe at the beginning, 1100, plus the new interest in this period, 110. Okay, and then you copy this number to the beginning of the third period. And then for the third period, how do you calculate the interest? So that will be the initial amount you borrow plus you got two interests in the previous periods, right? You got 100 in the first period, you got 110 in the second period, and that's your new base. And then your the total amount you owe at the end of the third period will be what? Will be the amount you owe at the beginning plus the new interest. Okay, so you just keep repeating this process again and again until you hit the end of the 10th period. Okay, and then if you want to know your total interest, that will be the sum of the column. Okay, the sum of the column, this column. All right, so if we calculate it manually, it will give us this total interest and this total amount you owe to the bank at the end of the 10th period, which is also the end of the 5th year. Okay, but don't worry, you don't have to do the manual calculation like this. We said we have that equation to use, right? So same example, but now let's use the equation to solve this problem. The equation is on this slide. Okay, we just copy this. So because this is a compound interest problem, so we use I equals to P times 1 plus I to the power of n minus P. Okay, and now we said P is the initial amount you borrowed, which is 1,000, and I is, let me move this, okay, I is 10%, okay, and what is n? N is not 5, n is 5 times 2, which is 10, okay. What is 5? 5 years. What is 2? 2 times interest calculation each year. Make sense? So in the end, you got 10 times the interest needs to be calculated during the 5 years. All right, so substitute these numbers. So P is 1,000 times 1 plus I is 10% to the power of n is 10, not 5, okay? Minus 1,000. Okay, so it's 1,000 times 1.1 to the power of 10 minus 1,000. Which is 1593.74. Okay, and then your total payback will be I plus P, interest plus the principal, right? So I is, you just calculate it, it's this number. So it's 1593.74 plus 1000. So it's gonna be 2593.74 US dollars. Okay, now you can check, compare these two numbers, this number and this number, to the form. Exactly the same, right? Which means the equation works, which also means our manual calculation works. But usually when you have such problem, I would like to use the equation method because it's quicker. Okay? So I hope by now you can understand why the number of periods, the interest periods, is a little bit tricky, and how do you determine the correct value of it. That's very important, okay? Okay, so now let's begin to learn something new. Cash flow diagrams. Okay? So this is a method for you to describe the cash inflows and outflows during a project on the chart. Okay? It's a way to show the money comes in and money goes out. So to draw this diagram, we have some rules to follow. Okay, so first, this is to show how you receive or spend money over a certain time period. It could be years, months, quarters, etc. Okay, depends on how often you calculate the interest. So if the problem statement said the interest is calculated every year, so on your timeline you have 0 year, first year, 2 year, 3 year, 4 year, and so on. If in the problem statement it said the interest is calculated every month, then on the timeline your period will be 0 months, 2 months, 1 month, 2 months, 3 months, 4 months, and so on. Okay, so you always have a timeline, and on the timeline you can show your money income and outcome, received and spent. Okay, so check it. And the second rule is you are going to draw a horizontal line as your time scale. Okay, that's very easy to understand. So you just draw a horizontal line, that's your time scale, and then your time spot or your time periods will be labeled on this time scale, on this line. So remember, if we said that interest is calculated every year for 5 years, then you're gonna have 0, that's the beginning of the first year, 1, that's the end of the first year, 2, that's the end of the second year, 3, that's the end of the third year, 4, that's the end of the fourth year, and 5, that's the end of the fifth year. Okay, that's how you describe the timeline. Okay, you draw this horizontal line and you put points on it depending on how many points you have. If you have the interest calculated every year for 5 years, you're gonna have this 1, 2, 3, 4, 5, 6 points and labeled as 0, 1, 2, 3, 4, 5. Okay, so the interest is calculated every year for 5 years. Okay, that's how you describe this. And one thing to pay attention to is the 0, 1, 2, 3, 4, 5, the meaning of them. Okay, so 0 means the beginning, of the first year. Okay, and the 1 means the end of the first year. Okay, it doesn't mean in the middle of the first year, or it doesn't mean in the beginning. The 1 means you already hit the end of the first year. Okay, so 2 will be the end of the second year, and the 3 will be the end of the third year, and so on. Okay, so that's how you understand these time spots. All right, and then the next bullet point for the rules is all cash flows placed at the end of the month or time period. Okay, we should say it's time period. It could be month or year or quarter, depending on how often the interest is calculated. Is it calculated every month or every year or every quarter? Okay, but so the 0, 1, 2, 3, 4, 5, the numbers could be the end of the first year or the end of the first month or the end of the first quarter. Okay, it depends on how the interest is calculated. Make sense? But all the cash flows will be placed at the end of each time period, which means your cash flows will be put on the time spot. You don't want to put it like right in the middle of that two numbers. This is wrong. Okay. And next rule is you always have a viewpoint for this cash flow diagram. You can look at the same cash flow from different perspectives or different viewpoints. For example, if you borrow money from the bank, then we have two perspectives to look at this cash flow. We can look at this from your point of view. So at the beginning, you borrow money from the bank. That money you borrowed will be your income. Okay, that will be the money you receive. You receive that money from the bank. Okay, and every month you can pay some money back, and then the payment will be your outflow cash. Okay, but if you look at the same cash flow from the same story from the bank's viewpoint, then the money you borrow from the bank will be the bank's expenditure, because that's the money outside the bank's pocket, right? So that's bank's expense, and every month the money you pay back to the bank will be the bank's income, right? So the same cash flow, the same story about the money in and out will be the directions is different. If you look at it from your point of view, if you look at it from the bank's point of view, the amount of cash flow will stay the same, but the direction, like if it's an income or outcome, that will be different. Okay, that's why we say you always have a viewpoint. You need to determine which viewpoint you are using to draw a cash flow diagram. Okay, we will see that in the example very soon. And the next rule is the downward arrows are expenditures. So if that cash flow is the money going out from your pocket, that's your expenditure, then the arrow which stands or which represent that cash flow should be going downward. Okay, like this one, that's an expenditure. Or another one, if it's going downward, which means that money amount will be the cost or expenditure. And then on the contrary, if the arrow is going upward, that means it's the money you receive, or that's your income. That's the money inflow. Okay? So we're going to use all these rules to draw a cash flow diagram for this example. Okay? So if 1,000 was borrowed from the bank by Tom, So now we have two perspectives, the bank and the Tom, okay? And 1,000 is borrowed at the beginning of 5 months at interest rate 0%, which is nice. So Tom paid 200 at the end of every month, and he paid that for 5 months continuously, okay? Now, can you draw the cash flow diagrams from Tom's perspective? Think about that. So first thing, you want to draw a horizontal line. Okay, and then how many periods you have? You have 5 months, right? So you got 0, that's the beginning of the first month. You got 1, that's the end of the first month. You got 2, that's the end of the second month. 3, that's the end of the third month. 4, that's the end of the fourth month. And 5, that's the end of the fifth month. That's the entire timeline, okay? And then from Tom's perspective, let's draw this, okay? At the beginning, which means at the beginning of the first month, Tom got 1,000 from the bank. That's the money inflow, okay? So that's the money received by Tom. Okay, so Tom think, okay, that's the money coming into my pocket. So you need to draw a line or an arrow up, going upward. Okay, and then you also need to label the amount of that cash flow just near that arrowhead. Okay, that's 1,000 US dollars. So this means you have 1,000 US dollars coming into your pocket as a receive. All right, and then at the end of every month, Tom will pay back the bank $200, okay, continuously until the end of the fifth month. So from Tom's perspective, that 200 is the money going out of his pocket. That's the outflow. So that arrow for that 200 should be going downward, right? So, and also we want to reflect the scale of the number, okay? So 1,000 should be much longer. I mean, the arrow should be much longer than the 200, right? It's just draw the lines to scale, okay? So you can draw a shorter line like that and label the amount 200 US dollars. And for the second month, at the end of second month, Tom does the same thing. He pays 200 to the bank. And this continues to the end of the third month, to the end of the fourth month, and to the end of the fifth month. Right? So in the end of every month, Tom pays the bank $200. And we said the interest rate here is, which is very nice, it's 0%. Okay, so this is the cash flow diagram from Tom's perspective. But think about that. If we look at this same story from the bank's perspective, then how do you draw this? First thing first, you need to draw the horizontal line as your time scale. Okay, so you draw the horizontal line, just the length you like, okay? And then you put the time spot. You're gonna have the beginning of the first month, the end of the first month, the end of the second month, the end of the third month, the end of the fourth month, and the end of the fifth month. Okay? But now you're looking at this story from the bank perspective. So the bank will lend 1,000 to you, to Tom. That 1,000 is the cash outflow. So it's the arrow going downward. Okay, so that's like this. And then you want to label the amount of that cash flow around that arrowhead. It's 1,000, okay? And every month, the bank will receive $200 from Tom. And that receivement is the inflow for the bank, right? So that will be the arrow going upward. And it's going to be shorter than the first cash flow because 200 is like smaller than 1,000, right? So it's going to be a shorter arrowhead. And you want to label the amount 200 near the arrowhead. Okay, and repeat that at the end of every month. Okay. Until the end of the fifth month. Did you see that? So the same story, but different perspectives. So what stays the same is the timeline is the same. The time spot is the same. The amount, exact number of each cash flow is the same, but the arrowhead direction is opposite. Okay, so that's why every time you draw the cash flow diagram, you want to first determine what viewpoint you're using. Okay, so I want you to just pause and then watch these slides again and then try to draw the cash flow diagram by yourself. See if you can get the same cash flow diagram as what I have. After that, let's look at another complicated example of the cash flow diagram. Okay, so here we said there is a company XYZ Corporation. They insist that its engineers develop a cash flow diagram of the proposal, what the proposal is. So the proposal is that the company would invest 10,000, okay, at the beginning of a project. And that 10,000 investment would produce uniform means same, okay? Annual revenue of $5,310 for 5 years. And then have a market value of 2,000. Market value means at the end of the project, you can sell that to another company and you can get 2,000 as your selling price. Okay? And annual expenses will be 3,000. Of course, you invest and then you have revenue, but you also need to, run the company, run the project, you have expenses, you have costs. And that cost every year is 3,000. Okay? And it said that's gonna be at the end of each year for operating and maintaining the project. Now, you want to draw a cash flow diagram for the 5-year life of the project. And it said you need to use the corporation's viewpoint. Okay? So now let's take a look at this. The first thing is you already know it's a corporation's viewpoint. Okay? Corporation's viewpoint. Okay, so now first thing first, draw the horizontal line as your time scale. And how many years we have here? It's 5 years, right? So here we don't have any interest rate, but we know that you need to calculate your cost and your revenue every year. It's the same as you calculate the interest rate, okay? So still that means you every year is your frequency to calculate the interest, equivalent interest. So you have 5 periods. So you start from 0, that's the beginning of the first year. You have 1, that's the end of the first year. 2, that's the end of the second year. 3, that's the end of the third year. 4, that's the end of the fourth year. Oh, I think this is too long. Okay, maybe I need more space. Okay. I definitely need more space because we have very big cash flows. Okay, now let's do this. I need the longer time unit. So the beginning of the first year, the end of the first year, the end of the second year, the end of the third year, the end of the fourth year, the end of the fifth year. Okay, that's the timeline. And from the corporation's viewpoint, you invest 10,000 at the beginning. You invest that much means that's the outflow, right? You give out this 10,000 to somebody else do the project. So if it's an expenditure, that arrowhead should be going downward. Okay, and look at that, 10,000 is the biggest chunk of money number in this statement. So that's the longest line. And then all the other cash flows like 5,000, 3,000, 2,000 should be shorter than this first cash flow line. So first it's outflow, so it's going downward. And you need to label that number. It's 10,000 going out of the corporation's pocket. Okay. And next thing, every year this project will make an annual revenue of $5,310. Okay, so which means in the end of each period you have income of 5,310, and that's smaller than 10,000. So the line is shorter than the first line. And it's going upward because that's your revenue, that's your income for your corporation, right? So it should be half of the length, like that. And you label that amount, 5,310. And repeat that for the end of the second year. Okay. And then for the third year, and then for the fifth year, or for the fourth year, and for the end of the fifth year. Okay, I should write it a little bit closer. Okay, and next. You also know that at the end of the fifth year, you have 2,000 recovery fee, okay? Which means at the end of the fifth year, at this time point, you can sell this project to another company and then you get another 2,000 as your income. So it's still arrow going upward, but it's an additional length. So you can draw additional line like that, and you label that 2,000. Okay, so to make it clear, that's something like that. And you need to move the first 5,000 on the side. Okay, so that you know that in the end of the fifth year, you got 2 cash inflows. One is the 5,310 as your annual revenue, and the other is the money you get from the selling of that project. Okay, and that's not the end of the cash flow, because every year you will expand you will spend 3,000 as your cost. So the cost is your money outflow. So the arrow head should be going downward. Okay, and so that's gonna be like this because it's the same amount every year. So I will just draw all this, arrow together and then label the amount 3,000 for each time point. Okay, so all the cash flows besides the first investment all happen at the end of each year. Okay, so they're all like happen around this timeline. So in the beginning there is only one investment. Okay, next, so let's learn something new. It's called the concept of equivalence. So equivalent here, what do we mean by equivalent? It means that, okay, so we said in engineering economy, we always want to compare different alternatives, right? Different projects, different options to invest money. And those alternatives you compare, they should be comparable. And they are only comparable when they produce similar results, when they serve the same purpose, or they accomplish the same function, right? You have the same goal, but you have different solutions, and that's the solutions you can compare. You don't want to compare solutions for different goals, which doesn't make sense, right? And but how can alternatives for providing the same service or accomplish the same function be compared when especially one interest is involved over extended periods of time? You see that usually projects options, they have different cash flows. Sometimes you got payment every month, sometimes you got the lump sum payment in the end, and different projects could give you different rate of return, like the interest will be different. So they are so uncomparable because they happen at different time stamp in a different way. So how can you compare these solutions at all? And so to compare them, we are going to use the concept of equivalence, which means we will convert each project's cash flow diagram to some single value. And that single value is called equivalent economic value. Okay, we convert the complicated cash flows to a single value at the same time point. And then we do the same thing for different projects. So for each project, we have one single value, and then we compare that single value for each project. We pick up either the biggest one or the smallest one. That's how you use the concept of equivalence to compare. Okay, so here the equivalent means these different options, solutions, they are equal to each other because they have the same goals. They serve the same purpose. They produce the same products. And also that single value is called equivalent value of the cash flow. Okay, because you're just doing some conversion based on some rules so that you can have just single value to compare between different options. Okay, here is an example of what is the concept of equivalence. Okay, so just imagine that you have 17,000 balance on your credit card. Gosh, that's a lot. Okay, so that which means you owe the credit card company 17,000. and you just decide to stop that. You don't want to pay the interest that don't want to pay too much in the end. So you have to stop that as early as possible. So you decide to repay the 17,000 debt in 4 months. That's your plan, which means after 4 months you pay off this balance. Okay, and you know that the interest rate used by the credit card company is 1% every month. So every month, if you don't pay off, then you will be charged like some amount as the interest, and that interest is based on the interest rate of 1%. Okay, so every month the company will calculate that interest. So you have 3 options to pay off. Here, your goal or the purpose of these cash flows will be to pay off that $17,000. Okay, which makes these 3 options equivalent options, comparable options, because they are doing the same job. They pay off that debt, but they're different cash flows. So the first option is you pay the interest of $170 for the first 3 months, and then you pay a lump sum of $17,170 at the end of the 4th month. So right now you don't have to worry about how you figure out these numbers, but you just need to know by doing this at the end of the 4th month, you will be the debt will be paid off. And so we can just draw a cash flow diagram to describe this. So you have a horizontal line, your time scale, and then you have 0, you have 1, that's the end of the 1st month, 2, the end of the 2nd month, 3, the end of the 3rd month, and 4, the end of the 4th month, because that's your plan. You want to pay back in 4th month. And you pay interest of $170 for the first 3 months. So we want to draw this from your perspective. Okay, so at the end of the 1st month, you pay $170. That's your money cash flow out. Okay, that's your out cash flow. So it's going downward, arrow going downward, and you label that 170. In the end of the 2nd month, you do the same thing. In the end of the 3rd month, the same thing. In the end of the 4th month, the same thing. Okay? Oh no. So in the end of the 4th month, it's not the same. You're gonna pay a lump sum of $17,170. That's a huge number. So the line, the arrow should be much longer. Well, we don't have much space, so just a little bit longer, okay? Just a little bit longer, okay? And you label that 17,170. That's your cash flow diagram from your point of view. And the option number 2 is you pay equal amount of $4,357.1 US at the end of every month for 4 months. In the end, you pay it off. Again, you don't have to worry about how do you figure out this number, but you need to know that the results is the same. You paid off the 17,000 balance. Okay, so if you want to draw this diagram from your point of view, still from your point of view, okay? You draw this line because we don't have any cash flow income, so I want to draw this line to the top so that we have, space for the arrows going downward. So 0, 1, 2, 3, 4. Okay. All right. And then it said at the end of every month, you're going to pay 4,000 something. So that's the money goes out from your pocket. That's your cash flow going out. So it's downward, okay? And you label that number 4357.1. Again, 4357.1. Again, 4357.1. Do that again because it said at the end of every month for 4 months. So you do that again at the end of the 4th month. In the end, you pay off the debt. That's the second option. And the third option is you don't pay anything during that 4 months, but at the end of the 4th month, you're gonna pay a lump sum. Okay? So we also draw this from your point of view. Timeline 0, 1, 2, 3, 4. You'd pay nothing in the 1st month, 2nd month, 3rd month, but you have to pay a lot at the end of the 4th month. So that's a long arrowhead going downward. And the amount is $17,690.27 US dollars. So here you have 3 options. They are equivalent because they do the same job. They pay off that balance, okay? And also, we got 3 different cash flow diagrams. So how can we compare which one is better? Okay? The logic is we want to convert every cash flow, the whole thing, into some value equivalent. Which means that value will, represent the cash flow. And we convert each cash flow into that single value. They could be different, they could be the same, right? And then you just need to compare these 3 values. And then you can pick out the one option you like. Okay, that's why we need to learn the concept of equivalence, and that's how we compare different options. Okay, just keep this logic in mind, and then we will teach you how do you convert a cash flow into a single value to compare. Before that, let's learn some notation first. And so the first is the I. So we have learned this already. I is the effective interest rate per interest period. Okay, it's not necessarily annual interest rate. It could be monthly interest rate, quarterly interest rate. Okay, that's why I said it's effective interest rate. I didn't say it's annual interest rate. Okay, so I is the first thing, and then N, the number of compound periods. We said N, it can be very tricky. It's how many times you calculate the interest. It's not necessarily to be number of years. Okay, it could be number of months, number of quarters, number of half years. And then the third thing is P or PV. Okay, so PV is the value of an amount of money reference to present time. Remember we said we want to convert the cash flows to some single value so that you can compare, right? That single value needs a time spot. It could be a value at present. It could be a value of money in the future. It also could be the value of money at the end of every interest period. Okay, but you always want to convert all the cash flows to the same time spot so that the single values can be comparable. You don't want to compare option 1's present value with option 2's future value. It's not comparable because we said money has the time value of money can change over time. right? You don't want to compare the present money with a future money. It's not comparable, okay? So, but here the P or PV is just the value of a bunch of cash flows, equivalent value of a bunch of cash flows at the present time, okay, or now. And don't confuse this P with the principal. Okay, principal is just the initial amount you borrow. So we also use P, but don't confuse these two P's. Okay, this P you can also write it as PV. That make more sense. That's P value. Okay, and then next thing is the F or FV, future value. Okay, so future value. So PV is the present value. Okay, future value is the value of an amount of money referenced to the some future date. Okay, so you can convert the cash flows to a future time, like the end of your project. That is also a single equivalent value of the cash flows, and that is also something you can compare to the other projects if you convert all the project's cash flow into the future value. Okay, and as I said, you also can convert the cash flow into something called annuity, which means that's the same uniform amount occur at the end of each interest period. Okay, so A is annuity. So which is the end of period cash flows in a uniform series for a specified number of periods. It starts at the first period and ends at the last period. Okay, so if you convert the cash flow to annuity, the annuity always occur at the end of each period. Say you have 5 periods, the annuity could be income or outcome, but it always at the end of each period, not at the beginning. Okay, and here we have some tips. So chapter 4 is all about the relationships between P, I, A, N, and F. So it's all about like how do you convert a value at present to the future, or you convert a future value to the present. How do you convert the cash flow to a future value, or to the present value, or to annuity, right? And so this is all about chapter 4. So you want to know how do you play with this, these letters I, N, P, F, A. Okay, so the first relationship we want to learn is the relationship between the future value and the present value. Okay, how do you convert a present value to the future? How do you convert a future value to the present so that you can compare different options? Okay, so we got different scenarios. The first scenario is finding F, the future value, when given P, the present value, I, the interest rate, and N, the number of interest periods. So that's the first scenario we will see. Many real life cases are under this scenario, okay? And one more thing is you can write a term to simplify this scenario. So here is how you write it. So F means what you want to find out. So you put the first letter as like what you want to find out. So if you put F at the beginning of this term, means you want to find out F. and the slash means given. So find out f given what condition, given p, the present value, comma, given I, the interest rate, comma, given n, the number of interest period. That's how you can simplify this scenario. Okay, just try to learn how to write this simplification term. Okay, now let's take a look at a real case. So what is under this scenario? Suppose you borrow 8,000 now. Okay, 8,000 now, that's a present value, and promise to repay the loan principal plus accumulated interest in 4 years. Okay, and the interest will be calculated every year. The rate is 10%. So the n is given as 4 and I is given as 10%. Then your question could be, how much would you repay at the end of the 4th year? Okay, so you're looking for the future equivalent of this cash flow, right? And you can draw this type of cash flow like this. So you got the timeline, and you look at this from your viewpoint. So you have 0, 1, 2, 3, and 4, right? And you borrow 8,000 now. So you have 8,000 as income. And the interest rate is 10%. Just label that on this time scale. And then you want to know how much you pay at the end of the 4th year, so that payment is equal to this cash flow, okay? So you want to know what is the future value of this cash flow. That's the cash flow diagram description of this statement, okay? And then also for this scenario, we can also draw a cash flow diagram like this. So this is a generic cash flow diagram for such scenario. So you usually have a timeline, but you don't know how many years or how many interest periods you have. So you label it as 0, 1, 2, 3. This means ... means unknown periods. And then you hit n minus 2, n minus 1, and then you get the end of the n time periods, okay? So this is a generic time scale. The n could be 5 or 10 or whatever numbers based on the real case, okay? And then usually this scenario will give you a present value P, which is given. Okay, and also the I will be given, and the question you want to answer is, what is the equivalent future value at the end, right? And if you have arrowhead going down at the beginning as a present value, that means you spend some money, and the question you want to answer will be how much you can get back. So the amount you question will be going upward, okay? And then you have the F, that's your future equivalent value, and usually it's unknown. So this is just a generic cash flow diagram for such scenario, okay? And another scenario is find the P when the F is given. Of course, the I and N will be given as well, okay? So you also can simplify this scenario by writing this term. So because you want to find out P, you want to write the letter P at the beginning of this term. and then the dash is the given. The angled line is the given, and the F is the given condition. So when the future value is given, and then the interest rate is given, and also the number of periods is given. Okay, that's how you simplify this scenario. And here we got a real case to help you understand this scenario. Suppose you have an option to buy a piece of land that will be worth 10,000 in 6 years. So this 10,000 in 6 years will be a future value of that piece of land. Okay, so this is a given F. And you know the value of the land increases at 8% each year. So that's your I. So the question is, how much should you be willing to pay now for this property? Of course, you want to pay as less as you can, but you want to know maximum price you want to pay so that you don't lose a lot. Okay? So you want to find out the equivalent present value for that future 10,000 in 6 years. And the diagram you can draw from your point of view will be the timeline 0, 1, 2, 3, 4, 5, 6. That's the 6 years. And then the interest is 8% each year. So I is 8%. And you know that the future value of that piece of land will be 10,000. So you can sell that piece of land as 10,000. That's your income. So it's arrow going upward, 10,000. And now you want to know what is the present value of it. And you want to just pay the present value. Okay? Or you want to pay less than the present value, which is a good deal. But maximum, you want to pay the equivalent present value. Okay? So the P is unknown, so it's dashed line, dashed arrow. That's how you can, draw the cash flow diagram for this scenario. Okay, so here we have another 2 scenarios. Okay, the first one is to find the interest rate I given P, F, and N. Excuse me. All right, I'm back. So here we have a new scenario, which is to find the interest rate I given P, F, and N. So what you know is your present value, your future value, and the number of periods, but you want to know what interest rate can make your present value equals to your future value. Okay? So here is one real case about that. Suppose that you have 10,000 that can be invested in a stock now. Okay, that's 10,000 you can pay for a stock at present. So that's your P. And you wish that after 5 years you can get 50,000 back. So that's your future value. Okay, so after 5 years, so that's your number of periods. So your question is, what was the average annual rate of interest a stock should have to make this happen? Okay, so which stock you want to buy? Because stock, they will have like average interest rate. Okay, you can check it on the website. So now you want to pick out the one you want so that you can make 50,000 after 5 years. Okay, to answer this, exactly what you want to find out is the interest. Okay, you calculate out the interest, and then you find the stock which has that interest. That's the one you want to buy. Okay, then the last scenario is finding the N when given P, F, and I. So you know your present value, you know the equivalent future value, you know the interest rate, but you don't know how long it's gonna be to make the present value equals to the future value. So an example could be, suppose you have 10,000 that can be invested in your retirement insurance plan, right? So we all invest in our retirement plan because we want to have some money back to the pocket after we retire, right? So the 10,000 is some money you can invest now. That's your P. And you wish after you retire, well, you don't know when to retire. You don't know how long it's gonna be. But you want, after you retire, you want to get 1 million back. Ooh, that's a big number. So that's your future value. But you also know that the insurance plan you can invest will give you 5% every year as an interest rate. So that's the I. Then the question is how many years you should be waiting or when you should retire. So the real question is what is the N? How many years that can happen? Okay? So these are the 4 scenarios we can solve or we can compare using the relationship between F, P, I, and N. Okay? Now let's take a look at how do we calculate the future value, the present value, the I and N. Okay? We just talked about the scenarios. I hope you can understand each scenario, the meaning of it, and also understand the real case. Okay? And then now let's talk about how do we calculate that. If we want to convert everything to the future, if we want to convert everything to the present, if we want to calculate the I, if we want to calculate the N. How do we do that? Okay, so finding F when given P, I, and N. Do you still remember how to write that term? Finding F, so F is the first letter, angled line, given what? P, I, and N. That's it. Okay, so practice this please because you're gonna use that term later. All right, so don't worry, you don't have to do it manually. The calculation, we use this equation. So F, future equivalent value, is P, the present value, times I plus 1 plus I to the power of N. Okay, this is the equation you can use. And now let's apply that to this example. Suppose that you borrow 8,000 now. That 8,000 you borrow is gonna be your present value, right? Promising to repay the loan principal plus accumulated interest in 4 years. So N is 4 at interest rate I, 10%. So how much would you repay at the end of 4 years? So you want to find out F. Okay, so F is unknown. Let's use this equation. So F is P 1 plus I to the power of N, right? And what is P? P is 8,000. I is 10%. N is 4. So we can substitute the P, I, and N with these values. So the F is 8,000 times 1 plus 10% to the power of 4. Right? So that's gonna be 8,000 times 1.1 to the power of 4. Okay, let me take a look at my note. So 8,000 times 1.1 to the power of 4 is 1.4641. So the final result is 11,712.8 US dollars. Okay, which means this is the future equivalent value of your cash flow. What is your cash flow? You borrow 8,000 now, and you have to calculate the interest every year for 5 years at the I equals to 10%. That's your cash flow. How do you convert all of this to the future value? Well, this is how you do that. You use this equation. Luckily, we have another way to do that. You don't have to do the calculation, but you need to check a table, okay? And here's how you do that. So here, this is the equation, right? But we can put this, 1 plus interest rate to the power of n. We can, somebody else already calculated this in different scenarios, like when n is 1%, when I is 1%, I is 2%, I is 3%, until I is 20%, and when n is 1, 2, 3, 4 until 100. So somebody has already calculated the different combinations of this term, okay? And then we have a term or a factor to represent this term. So here, 1 plus I to the power of n can be written as what? You're gonna like it because you have learned how to write the term. To find the f given p, I, and n. So remember, this is a term we simplify that scenario. And if you give it a parenthesis outside, this becomes a factor to use to calculate the f using this table without any, manual calculation, like to the power of n, something like that, okay? So this is another approach. We just call it factor approach or table approach, okay? So now what you do is to use p times a factor. And that factor is f given p, I, and n. Okay? And now your next job is to find out the factor, the value of the factor. How do you do that? You just need to check a table like this. So this is the table in the appendix C. You have multiple tables, and depends on what is the I, what is the I, so that you can use different tables, okay? So we use this example to show you how to use the table. So the same example, you borrow 8,000 now, that's your P, and you promise to repay after 4 years, so N is 4. At the interest rate I equals to 10%, that's your I, okay? So how do you use the factor or table method to do this, to calculate your future equivalent? You go check the table in the appendix C, but you want to find the table of I equals to 10%. Okay, so different table has different I, but you want to find out the I for this problem, which is 10%. After that, you are going to find the factor of this, the value of this. How do you find it? So you want to check the column, different columns, right? But each of them represent a single scenario. Check this. Find f given p. That's our case. We want to have f given p, I, and n, okay? So this is the column you are looking at for this problem. And then you want to find out which row to look at. The row is number of n, okay? So here we have n equals to 4, so we need to look at this row. So now you have a row to look at, you have a column to look at. That will give you the number there, a cell. And that is the value of the factor you're looking at. Okay, so to calculate this f, you use the p times that factor. And that factor, you can write it as given f, find the f given p with 10% and 4 years. Okay, you can just, replace the letter by the values you already know. And the p is 8,000. And that factor is, what we have already found is 1.4641. That will give you 11,713. Exactly the same as this answer. Okay, so both way works, but usually we will use the table method. All right, so next, how do we find the p when given f? Okay, again, we still have two methods. One is equation, one is table method. And the equation is, wow, it looks very long, hard to remember. But let's apply that to this example, okay? So the equation tells you the present value. If you want to find the present value of a given f, I and m, you want to have the f times this term, okay? So now the question is, an investor has an option to purchase a tract of land that will be worth 10,000. So that's your future value, because it's in 6 years. If the value of the land increases at 8%, that's your I, each year, how much should the investor be willing to pay now? So that's the present value, unknown. So yes, you want to use this equation. So P is F times 1 plus I to the power of negative n. And F is 10,000. I is 8%. N is 6. Okay, so 6 years, that's your N. So the P is F, we just substitute the values, okay? So 10,000 times 1 plus 8% to the power of negative 6. Okay, and this is 10,000 times 1.08 to the power of negative 6. 1.08 to the power of negative 6 is 0.63017. So this will give you 6,302 US dollars. That's your present value. That's the price you want to pay. You want to pay this as the maximum price, okay? You want to, of course, you want to negotiate, and then you want to pay less than that so that you can gain some value from this piece of land. Also, we can use the table method. Okay, look at this equation. This is also a term somebody can, calculate for you in advance. Okay, they just use different combination of I and N. And so that you can write this as f, the future value, times a factor. But here, this factor is going to be written in another term. Okay, so what term? You can imagine that. It's going to be to find P given F, I, and N. That's just the term we have learned before to simplify that scenario, right? So it's not a big deal for you. And then the next thing is, how do you find out the value of this factor? Of course, you use the table in the Appendix C. Okay. So let's use this example, the same example of buying a piece of land. Okay. So here you have future value given, which is 10,000. N is 6. Interest rate I is 8%. And what you want to find out is the P. Okay, so in the table method, you want to find out the factor of this for this problem. How do you find it out? First, you need to find out which table to use. As what I said, you always find out the table for the same I. So I equals to 8, that's the table you want to use. And then you check the column heads. Okay, you want to find the P given F, so P slash F. So is it this column? No. Is it this column, P slash F? Yes. So that's the column you want to look at. Now you need to find out the row. And the row determined by the number of periods. So the N is 6. So you find 1, 2, 3, 4, 5, 6. That's the row you look at. So now you look at this column and this row, that will give you this cell. So that's the factor, the value of this, the factor of this problem. So you calculate this as P is F times the factor P given F for I equals to 8%, N equals to 6. That's the factor you're looking at, okay? And then F is 10,000, and that factor is 0.6302. So you got $6,302 as the present value, as the price you want to pay at most, okay? So compare this to this value, that's the same. So both way works. And usually we want to use the table method. So right now I want you to pause and try to practice to find out the right table for the example and to find out the right column, the right row to look at so that you can find that exact factor and then use this factor method to calculate your present value or your future value. Okay, so using this table is very important. Of course, we can also calculate the I and the N, okay? And here, unfortunately, we cannot use the table method. We can only use the equations, okay? So to find out the I, this is the equation to use. It's a little bit complicated. Let's use that for this example very quickly. So the average price of gasoline in 2005 was 2.31 per gallon. In 1993, look at this, that's the earlier times, and 2005 is the later time, okay? So you have two time spots. And so which means the value of the gasoline in the later time is gonna be your F. And then the price for the year 1993 is gonna be your P. And what was the average annual interest rate? So I is something unknown. in the price of gasoline over this 12-year period. So N is 12. Okay, so this problem want to find out the I, which can make the present value of the gasoline in 1993 equals to the future value of the gasoline in 2005 during this 12 years. So you know you're gonna use this equation, right? And your N is 12, your F is 2.31, your P is 1.07. What is the I? So I is, you can substitute the letters with the given value. It's 2.31 over 1.07 to the power of negative 12. Well, it's not negative 12, it's 1/12. That's the root, okay? Minus 1. And if you calculate this, the answer is 0.0662. So if you write it as a percentage, it will be 6.62%. That's your interest rate. Okay, so just use the equation, and the key is to find out these values correctly. All right, so the last calculation is to find out the N when given P, F, and I. So here we use this equation. N equals to log F over P over log 1 plus I. Okay, a little bit complicated. And let's apply this for this example. Okay, so the average price of gasoline was given as 3.31 in 2005. We computed the average annual rate, so we don't know if it's a P or F right now. Okay, so we need to decide it later. We computed the average annual rate of increase in the price of gasoline to be 6.62%. So that's your I. If we assume that the price of gasoline will continue to inflate at this rate, how long will it be before we are paying $5 per gallon? Okay, so continue to inflate, which means this $5 per gallon will be your future value. Okay, so that makes us to think this 2.31 will be the present value. Okay. So now the way you do this problem is you use the equation. So but before that you need to find out the values of these letters, right? So F is $5, P is 2.31. Excuse me. And I is 6.62%. Now we can substitute the letters with these values. So log F5 over P is 2.31. Let me erase this. Okay, over log 1 plus 6.62%. So if you calculate this, that will give you 12. Okay, so after 12 years, the price could be 5. Wait a second. We need to calculate it. Okay, so first we need to calculate the log. Log 5 over 2.3, that is 0.34, and then we calculate log 1 plus 0.0662, that is 0.03. Okay, so now 0.34 over 0.03 is 11.33. So your N is 11.33 years, which is almost 12 years. Okay. All right, so this is how do you calculate I and N, but unfortunately we don't use the table method, so you have to use these equations. But don't worry, because we are open notes, open book exam, so you don't have to remember this equation, but you have to understand what the F means, what the P means, what the I means, and you need to find out the right value from the problem statement. Okay, so this is all for today's class. I know there are a lot of things you need to digest, so feel free to just pause and then rewatch the video. But you want to make sure that you understand the concepts and the method.